There's been 4 periods over the past 100 plus years where the stock market's done 15% per year for over a decade. And they all have names: Roaring 20s, Nifty 50 period, internet bubble, and COVID meme stonk, whatever we're calling this era. And, on the backside of those, you had some pretty tough times. If we say today, and I will say this, that the U.S. stock market is very expensive, I will say that. They assume that means it has to crash, it has to go down. That is absolutely not what it means. If you look at a portfolio of cheap CAPE ratio countries, so ex-US countries, that strategy is now outperforming the S&P over the last 1, 3, and 5 years. You cannot be an honest person with a straight face, a mathematician, a quant, a scientist, and look at the historical evidence and claim that managed futures and trend is not the premier diversifier to a traditional portfolio.
Hey, Meb, welcome back to Excess Returns.
Great to be back, guys. Good to see you. Go Dodgers.
Nice. We in our audience always enjoy having you on. It's just such a wide-ranging discussion we can have about markets, investment strategies, ETFs, and I think a lot of other, investment-related topics and themes. It's interesting. I was just looking because I was like, how long has Cambria been around? I was just curious as to what. And actually, November, I'm sure you know this, but the firm is going to be coming up on its 20-year anniversary of.
What should we do? How should we celebrate?
Well,
what's the 20-year anniversary anyway? I don't know. Is that rubies, diamonds, whatever it is? It's funny because I find myself as I get older, and I'm sure the listeners can have the same experience, which is I'm like, man, I was talking about college the other day in Virginia. And I was like, man, I graduated in the year talking about the bubble, year 2000. I can't believe that was like 10 years ago, like in my head. I'm like, I can't believe the GFC was only a couple years ago. And I'm like trying to do the math. And I was like, yeah, wait, we've been around 20 years. So it feels a little crazy for sure.
No, but I think it's awesome. And it's a testament to sort of what you and the team have built over there. And so, for people listening to this, you can learn about all the different things that Meb and his team are doing: ETFs, trend following strategies, 351 exchanges. You can go to a couple different places: CambriaInvestments.com, CambriaFunds.com, and also one of the original guys in the investing podcast space.
If you're watching this on YouTube and you see this sweet new swag hat I'm wearing, you guys email me. I'll send you one or a book. It's funny. I gave a speech to Google back in 2014. And in that speech, I say, if you're watching this and you're in the audience, you're watching on Google, email me and I'll send you a hat. I still get emails this day from people that are watching this video on YouTube being like, can you send me a book? And I was like, bro, this was 12 years ago. Like, come on.
You still send the thing?
This expires at some point. Well, I put most of my books are for free online. You can get the ebooks, almost all of them free. I got into a big fight with Jeff over at Amazon. I said, you know what, buddy, forget it. I'm just going to put all my books online, or at least that I can help it.
Well, that's the cool thing with YouTube, though, is stuff does resurface. So to your point, something that was given over 10 years ago, people are still watching it, and I'm sure
good and bad. That's the good and bad part about it. Yeah.
Yeah, and I don't think I want my tape that small cap value is going to outperform from a decade ago. I don't think that I want that thing resurfacing. So I guess it depends on what it is.
So there's a number of kind of topics that we thought we'd just try to work, through with you today. And the first one is, the U.S., since the financial crisis, really, speaking of that, the U.S. has been sort of like the dominant stock market in the world. Aside maybe from, there's been a couple little fits and starts with different international markets, this year being one of them. But overall, when you look at the long-term 10 or 15-year return, the U.S. market has just basically beaten the pants off almost everyone. And at the same time, the U.S. stocks have kind of been, in most of that period, at above average historical valuation. So we just thought it'd be interesting to get your take on, do you think something has maybe permanently changed with U.S. equities in particular, where their valuation today, it's just permanently higher than it maybe has been historically for whatever reason? Maybe they're more efficient, maybe they're more tech-based and more growth-oriented. I don't know. We just want to start there and see kind of what your thoughts were on that.
Well, the short answer is absolutely not. The longer answer is, look, it's been an amazing time to be an investor, y'all. I gave a speech this past week in Minnesota, and I said to the crowd, it's a lot of planners. I said, I'm sure you're sitting down with your clients in a year and saying to them, by the way, this is as good as it gets. Like, I just want you to appreciate, client, it does not get better than this for U.S. stocks. My favorite chart of the last year or so has been a rolling 10-year returns of the stock market. And there's been 4 periods over the past 100 plus years where the stock market's done 15% per year for over a decade. You get really rich quick at 15% per year, by the way. But it's only been 4 times that's happened, and they all have names: Roaring 20s, Nifty 50 period, internet bubble, and COVID meme stonk, whatever we're calling this era. And, on the backside of those, you had some pretty tough times: Great Depression, inflationary 70s, internet bubble burst, as well as the GFC. But the whole point is being that you have these periods in markets. And I'm actually writing a new book, should be out in Q1, about the history of stock markets back to 1600. And you can kind of look and see that, look, these regimes happen throughout time. And the really technical way to say it is the good times tend to follow the bad. And what we can kind of learn from this, I was watching NBA just started back up this past week, and they were asking a bunch of the young players and said, hey, we're doing this new feature. What do you remember from NBC, doing NBA in the 90s? And you just saw this like blank expression from all the players. And they're like, I wasn't even alive yet. Like, what are you talking about? This goes back to the early part of our conversation. Like, what do you mean the 90s? Like Michael Jordan, maybe? Like, I don't know. Literally, all of them had not been born yet. But the reason I mentioned that is that all of us are extrapolating from our own lived experience. And if you're a younger person living this, 15 years is like a career, right? That's a really long period in markets for kind of it being one environment, which is romping, stomping U.S. stock market, largely creaming everything else until recently. We can come back to that. But to answer your question on valuations, for perspective, we use the 10-year P ratio, but we publish 5 different ones for all the global stock markets. And it doesn't really matter which one you pick. They all say the same thing. It doesn't matter if you use forward PE, doesn't matter if you use backwards PE, 1 year, if you use price to book, if you use Tobin's Q, market cap to GDP, on and on. They should all rhyme when something's expensive like the broad U.S. stock market is now. So the 10-year P ratio, let's call it 40. Dividend yield of 1.17. Both of those are knocking on the all-time lows for dividend yield, 1.1 at the internet bubble peak, and then the CAPE ratio of 44.5. But that's the thing with valuation. I feel like this is the biggest misconception when it comes to valuation, is people assume, if we say today, and I will say this, that the U.S. stock market is very expensive. I will say that. They assume that means it has to crash, it has to go down. That is absolutely not what it means. The PE ratio could go up to 50, 60, 70, 80, 90, like it did in Japan. There's nothing stopping that. Animal spirits, baby. And that just means it went up more and got more expensive. And that's how it works. But I think the odds change, right? The spectrum of future probabilities of what can and should happen, just like at the blackjack table, the poker table, I think you have to play those odds. And in history, and I'll wind down here, we examined when all the global stock markets, when they closed the year at 40. So we haven't closed the year at 40 yet. We got a few months, but let's say we close at 40. On average, the future real returns are about 0. And there's not been one time in history where the future 10-year returns were above average, meaning let's call it a 5% real return, right? So it's never, not once. So when you guys have me back on in 2035, we're doing holograms at that point, I don't know. And we look back, the chances, the odds are that the future returns for the market cap weighted, that's the key word here, will probably be pretty subdued.
So play that through in terms of like how an investor should sort of think about this, because I'm thinking like, international diversification could be one good idea. Maybe adjusting one's return expectations could be another. Maybe paying a little bit more attention to tax efficiency would be another. So just kind of work through some of what would be the, I guess you could call it tactical and strategic things that an investor should be thinking about with valuations where they are today.
Yeah. So let's assume this is a tax exempt account. You can just do whatever you want. You're not worried about taxes. When we started that bull market back in 2009, the CAPE ratio was 12, right? So it's screaming cheap. And then on average, roughly, it hangs out most of the time, kind of that 18 to 22 area. And we actually wrote a piece, and I think this is really important because the thing that people get wrong with valuation, they assume the menu on the restaurant is stocks or nothing, SPY or nothing. And so that is like the placebo, like I say, if I'm out of US stocks, the alternative is nothing. But that's not the case. It's not like a in and out menu where you have two things. Like there's a whole secret menu of things you can do. You can move to cash, you could go in T-bills, you could move into foreign stocks. And we have an old post and we were kind of talking about how, some macro commentators were talking in the early 90s that stocks were expensive, and not to dunk on Seth Klarman. He's a world-class hedge fund manager, but he was talking about how stocks were expensive. And I said, what if you just got out of stocks, when they went above a CAPE ratio? I don't even remember, 20, 25, something, not that high. Terrible idea, right? Like horrible idea. If you did nothing with that money, if you actually went into bonds, it was totally fine. And if you went into a different choice, which is you stayed in stocks, but they were global stocks, so like global value stocks. So you can see I'm wearing a GVal hat. It was actually a great idea, right? So you totally preserved your wealth. You just moved out of the one country. So what are your choices? Here's the main choices that I think make the most sense. Every time I talk to a U.S. investor, y'all know this, they're all in on U.S. stocks. The U.S. is 2/3 of world market cap, despite only being a quarter of GDP. But nobody I talk to puts a third in foreign. Like it's like almost never. And that's just the starting point. That's the market cap. Like that's where you should start. So if you're valuation conscious, you could argue, hey, maybe I'll do even more in foreign. Maybe I'll do a GDP weight or something. So within the US, you can break the market cap link. You can do things like equal weight will be better. You can do things like, or will likely be better. You can do things like we like shareholder yield, but value, multi-factor that y'all talk about. You could do things like adding foreign and emerging. Those broad markets are like high teens, low 20s, totally reasonable. And then you can do value globally. In addition to all the other asset classes, the two big mistakes that we see people make in the US is way too much in the US, so US only. And second is they almost never have real assets, tips, precious metals, REITs, on and on. So those two big factors, I think, would be a huge benefit to portfolios. I mean, we wrote this piece a couple of years ago called The Bear Market and Diversification, talking just how tough this period was for any asset allocator, financial advisor, any diversified portfolio relative to the S&P. But I think that's changed. So this was arguably the worst period in history. The only thing that's even close is post-World War II. I think it's shifted, actually. So I think the bull market and diversification has begun because it was something like 12, 13, 14 years in a row where the U.S. pummeled any diversified allocation. 2022 was kind of the only survivor. But here we are in 2025, and I think it's shifted. And I'm going to drop you a spooky stat because this is right around Halloween time. We're talking about this. Not a single listener is going to believe what I'm about to drop. So you can go check it yourself, y'all. But if you look at a portfolio of cheap CAPE ratio countries, so ex-US countries, and we have a fund that does this, that I've already mentioned, that strategy is now outperforming the S&P over the last 1, 3, and 5 years. And I don't say that as if this is the most magical, amazing fund, because it was pretty stinky before that. What I'm pointing that out for is that it feels like there's been a disturbance in the force. So because the U.S. is at all-time highs, you go turn on CNBC, all they're talking about is U.S. stocks, NVIDIA, Mag 7, AI, and now a little gold, right? Gold has entered the chat because it's at over 4,000. But other than that, no one's talking about foreign, no one's talking about deep value, and that strategy is up almost 50% this year. So pretty soon, I think people will start taking notice. And so every advisor who sat with a client for the past 10 years, and that client said, "You numbskull, why in God's name do we own emerging markets? Are you joking? Why do we own small cap value? Why do we own all these things?" They're going to sit down by the end of the year and be like, you numbskull, I told you, why don't we own emerging markets? Why don't we own gold? The memory is short, but I think it's shifted. So there's a lot of choices out there on the menu. I like animal style is my secret choice.
You're basically summarizing every conversation I've had with clients in the past 10 years. Why the value? Why the international? And to your point, at least this year we can we have some positive stuff going on.
Yeah.
What do you think about trend following as somewhat of a solution for an overvalued market? Because one of the things of research you did that was kind of eye-opening for me is this idea that I believe if you look at the quadrants with respect to valuation and trend, I believe an expensive uptrending market is actually the second best quadrant to invest in. So you could argue maybe using trend as a way to help me here deal with this could be a good solution.
Yeah, we probably love trend more than any advisor in the country. And we like to point out and talk about, we have soon to be 20 ETFs. So when you got 20 ETFs, something's always stinking it up. And so a handful of years ago, I was getting a little frustrated with, everyone on social just always talking about what they were doing that was amazing. They're traders, they only make money. And I was like, if you're an older trader, you got a lot of scars. Like that's not what it's like. Do not confuse these young people. It's mostly about losing money and not losing all your money and just surviving. Going back to the 20-year, we often say it's like the best compliment you can give someone is you just survived. And so we wrote a profile of a fund. Our first one, we said totally not crushing it. It was about a fund that essentially does that quadrant strategy. So it's called VAMO. It buys 100 stocks with good value and momentum strategies, but it'll hedge the portfolio in 25% increments based on half of its top-down trend and the other half is top-down value. So not surprisingly, right now, it's 50% hedged because the market's expensive but going up. That fund for a long period was super stinky, did not do a good job, trailed the S&P, everything it owned underperformed, hedging with the S&P hurt. And so we wrote a profile of the fund and said, hey, look, we want to talk about our worst performing fund. We want to talk about why it's doing so poorly. And do we think it's broken or is it just in a random period, a bad regime, on and on? And of course, we concluded we thought this was a pullback, a great time to be adding. And I think, sacrificing at the altar of the market gods is a good karma thing to do. And like almost to the day, that fund has turned around and done wonderfully. We actually did it again with the global value deep value strategy, and almost to a day that fund has turned around. And I need to write it about our managed futures strategy because our managed futures this year, along with everyone else, is like the worst 12-month period in the SocGen Trend Index history. But it's a good point when we talk about things like trend or things like value. So people will say, hey, Meb, your value fund is stinking it up. And I say, well, to be clear, you're talking about the one in the US that's targeting small and mid caps, because the value funds outside the US, like you mentioned earlier, are up 20, 30, 40, 50%. So just saying value, there's a wide spread between what it means. Same thing with trend. We have a handful of trend funds. I think just to show the dispersion, there's one that's up 20 something percent this year, and there's one that's down 5. And so the choice of markets traded, the choice of the trend algorithm, meaning is it long, is it mid, is it short? But the biggest one is it going long and short? And so, the benefit of a traditional long short is I think that's actually the best diversifier to a normal buy and hold allocation. But you're going to look the most different usually. So if you're just doing trend on the portfolio alone, long flat, totally would be my choice. But if you have a buy and hold portfolio and say, I just need something to hedge this, long short would be my choice. But this year is a great example of diversification, meaning always having to say you're sorry. There's something that's going to stink, but that's a feature, not a bug.
Since you asked about managed futures, I want to ask you about this whole idea, because this is something we do with clients a lot. Like we've never run really like more of a traditional stock and bond portfolio. We run something that's sort of based off the permanent portfolio, where we've always got some gold in there. And then when I did some research, what I realized is putting managed futures on top of the permanent portfolio, like as a fifth thing, has incredible benefits because of what it does in the drawdowns and because it doesn't have huge losses. So how do you think about that whole idea of like running a stock and bond portfolio, which, we just had Rick Ferry on, and he will tell you is a very good long-term strategy and you shouldn't add anything to it. But like when you do the math, like adding these other things in tends to add a lot of value, I think. How do you think about that?
You cannot be an honest person with a straight face, a mathematician, a quant, a scientist, and look at the historical evidence and claim, and I love Rick, this isn't about Rick, and claim that managed futures and trend is not the premier diversifier to a traditional portfolio. And it's for a couple reasons. So looking at a traditional US portfolio, most people, again, going back to our own lived experience, right? You've been managing money the last 15 years, all you've known is US up. But it varies based on when you were born, where you were born, so not just what country, but what part of the country. You know, Vanguard's got a great study that shows equity allocation just by when people were born, and it's hugely different. So if you started learning when the GFC was going on, totally different than, you know, YOLO culture of today. But the point being is that this is true for asset classes. This is true for, hey, your perspective on gold. You're born in Australia or Canada. Guess what? You have probably a much higher allocation to gold, or China or India, than you do if you live in the U.S. On and on and on. And so, two of the benefits to a managed futures or trend, a lot of people have come to the assumption that bonds hedge stocks, treasuries hedge stocks. And that is a very dangerous assumption. They do sometimes, but as was evidenced by 2022, they didn't. That was a very painful year for a lot of traditional U.S. stock bond investors. The first half of the 20th century, bonds often didn't help during downturns. And if you hadn't studied that period, you would have assumed that the bonds always hedge stocks. So what does help that portfolio? Well, one of the benefits to a traditional 60-40 in the U.S., a managed futures or trend, is two things. One is in uptrends. So like this year, this is a great example for a lot of certain type of exposures. You don't have exposure to things like precious metals and gold, right? A normal portfolio, y'all do, permanent, but most people don't. And so those type of portfolios will give you those exposures. But the big part is on the risk management downside, you know, where when things really hit the fan, and let's be clear, they haven't in 15 years. You've had a couple of these little 20% dippers in the US, but nothing real bad like we've had in a lot of other places. You know, that tends to be where it shines. Managed futures did great in 2022. This is like the only thing on the planet that's going to be short bonds. Almost no active manager, long, short, you know, on and on is really going to benefit you in that environment. So I think there's a lot of benefits. We're probably furthest out on the spectrum of advisors in what we think a reasonable allocation to trend is. And I think you can argue 50%. And I haven't met an institution ever that really goes above, 10 if they've bought in, 20% if they're crazy, 25% if they're willing to lose their job. But we tend to be the nuttiest of them all, and our default is 50.
Yeah, it comes down to the difference between math and behavior, I think. Like the math of it makes 100% sense. And then you can only use as much of it as your clients can deal with when it's like, my managed futures fund is in the tank this year and stocks and bonds are up. Like you've got to do it enough that, you know, you get the benefit, but that people will stick with it during those bad periods.
Let me give you one more example on how important it is to be open-minded about asset classes and strategies. So, you know, investing, so many people come in with almost like a religious cult-like belief. And there's a very intelligent, and I actually really like him, so I'm not going to mention his name, investor who oversees, you know, it's almost $1 trillion now. But he was talking about a while back how gold has no role in a portfolio. And he was comparing it to 60-40. And I said, let's run a fun thought experiment. I said, let's just replace the entire, so 60-40 is 60% US stocks, S&P, 40% bonds. Let's call it 10-year bond. Let's just replace the entire bond exposure with gold. Like clearly, according to your logic, this is going to decimate returns. No one would ever do this. The dumbest idea on the planet. Guess what? It makes no difference whatsoever to the allocation over the last 50 years, over the last 100 years. And I updated this study, it was like a year and a half ago. So re-updated, it's going to destroy 60-40 stocks bonds. But the point being is like, you can't just repeat things. You got to, you know, test it. It's like, what does this actually mean? And it turns out, you know, that it's not a dumb idea. It actually historically was a fantastic idea to include gold. Now, I think the best interpretation of that is to do both. that own both gold and bonds, but coming to investing with sort of this closed-mindedness on like any asset, I think has probably cost people a lot, a lot of missed returns when it comes to different regimes and times when something else does better than their pet asset. And you can apply that to a lot of things.
How do you think about concentration? Because as a value guy, I'm like the guy who was shaking my fist at the Mag 7 and like how expensive they are and how cheap value stocks are. But I also have to say on the flip side of that, I mean, they have done very well fundamentally. So there is certainly justification for those being the biggest companies in the world, at least right now. Like, how do you think about concentration? Do you see it as a risk to the market? Like, how do you look at that?
Well, in this new book we're writing, we start in 1600 with some of the first joint stock companies. And so talk about concentration, because the index was like one company. Then it was two, then it was five, then it was 10. But even those, those companies are now gone, right? You're not talking about VOC on this podcast. You're not talking about East India Company or, some of these companies. And what we talk about is a lot of examples. We say, look, the U.S. is 10 times bigger than any other stock market in the world, but it didn't always hold the crown. The Dutch used to have it, and UK used to have it, Japan used to have it in my lifetime. And that's true with the companies. Like, I love seeing those decade charts where it shows the top 10 or 20 companies by market cap and then the flags of where they are. And right now it's all US and US tech. And but if you look back a decade ago, there was a lot of China mixed in. If you go back a few decades ago, it was all the Empire of Japan. That beautiful white flag with a red dot was most of the stocks. And so these things kind of wash and wane. But the market cap weighting is such a curious idea when you think about it, where, it's a great way to get exposure to the overall market and you're guaranteed to own the winners. But the problem is there's no tethered valuation. And so historically speaking, it's a pretty good exposure, but I think there's pretty easy ways to beat it. The simplest, and I said this on Twitter, I said my favorite way to beat it by 20 basis points a year, just take out the largest stock. That's it. You beat S&P by 20 basis points, right there. And so there's plenty of things you can do. Again, you can equal weight, you can value weight. The problem is, here's the problem. The long history, if you compare market cap weight to anything else, or particularly the very high concentrated, it's a pretty bad strategy. So it consistently underperforms every once in a while. And it's particularly during the bull market romps, the face rippers, it just goes vertical. And something that's concentrated, it's all the positions go straight up. But that sets the stage for the next, period of underperformance. We put out a paper on this topic and kind of outlined a few of the periods and said, this is what's happened in the past. But that's the Achilles heel flaw of market cap weighting. It has no tether to value. And so eventually, gravity has its effect, and we'll be fondly looking back on all these names in the top 10 stocks 10 years from now, and talking about the new ones. But it's it can last a lot longer than any of us expect.
How do you think about AI, like thinking about these revolutions from the perspective of an investor? Because we're kind of caught up in that right now. And it seems like it's going to be a very, very major revolution. And even I fall into the trap a little bit of like looking at it and saying, all right, I got to figure out what the winners are going to be here, because, the next Amazon or whatever is sitting there in front of me and I got to be able to figure that out. So how do you think about a revolution like this from the perspective of investors?
That's the beauty of having both hemispheres of the brain, right? You got one foot in valuation, one foot in trend. And if you look at like our global momentum and trend ETF this year, it shouldn't ever surprise you what's in it. And so this one doesn't short. It's just long, flat, can move to cash. You can always guess what's in it. So having heard everything we've talked about today, you wouldn't be surprised to know it's mostly stocks, mostly ex-US stocks, so foreign stocks, few sectors in there, a huge slug of precious metals and miners, and then a sliver of Bitcoin as well, right? But I don't have to have an opinion on what's happening. And often my opinion is directly inverse to what those positions are holding. And so there's a lot of times, think back to 2007, you're like, oh man, I don't want to sell my REITs right now. Like, I don't want the party to be over. I'm not ready for this. And same thing about buying in, be like, oh my God, this is going to be way worse. I remember thinking back during COVID, being like, dude, this sucker is going to go down 80%. Like, I don't want to be buying now. Like, what a nightmare. And so trend has a way of putting you in some of these things, even when you don't want to be. But as far as AI, I'm having a lot of fun. I take a AI class by my one of my local dads, Kei over at Rad Reads, which I would highly recommend. we built a custom GPT on all my content. So we'll put a link in the show notes, but all my books, white papers, blogs, Twitter, and you can ask it questions. You can be like, all the questions we did today, we could probably ask them. It'd be fun to see what it does. We'll have like a Meb Real podcast and a Meb AI podcast and see if you can tell which one's which. And because it got trained on Twitter, it's a little cheesy. Like I hear some of the responses and I'm like, is that what I sound like? Would I say that? But it's like 90% me. Like it gets all the nuance. Like you can even ask it portfolio questions. You can be like, here's my portfolio. What would you recommend? And it comes back and I'm like, oh, that's actually probably what I would say. The downside is if you ask it like a relationship question about like your wife or something, it'll couch the response in terms of risk and drawdowns and everything else. So it's kind of limited to investment world, but it's fun. We've built them with financial historians. So I'll be like, hey, here's my Mount Rushmore. What would these 4 people say about this topic? And like Munger will weigh in and Arnaud will mix it up with Asness and on. And, so it's been a lot of fun. It hasn't made its way that deep into portfolio. It's more been kind of content and ideas around that. But we're open. I had a fun podcast where I got translated into Italian. And my wife speaks Italian, and we sent it to her. She's like, what in the world is happening? It's getting real weird real quick.
And I believe, didn't you also make a video of you at one of the major pension boardrooms saying some things?
That was CalPERS. That was an AI. That was a real video of everyone crying when I told them that I'm going to fire all of them and all the private equity funds and replace them with ETFs. It's weird. They all look like Lego figures. But the most unrealistic part of that video is I'm drinking a beer and squinting as if I really hate it. So maybe that beer was like an amber. I don't love ambers. I can't. I'm too old for IPAs anymore. I drink them now, and it just gives me a hangover. So maybe that's the key that it was AI driven.
We've got to teach the AI how to make you enjoy your beer. I guess that's the next level of AI development.
It's a lot of fun. It's a deep rabbit hole once you start creating.
Do you think at all about comparing like this period to the .com bubble? I mean, some people will try to like take lessons from that, or other people will say who think this is nothing like that will say, we're not dealing with Cisco at 100 times earnings here. Like these companies are trading at much more reasonable valuations. We could have a long way to go. Like, do you think there's any value in comparing this period to that period?
Yeah, I don't get too caught up in the analogs. I feel like that's very tempting and seductive. People really want to do that. I think they always rhyme and in different ways. Markets are always like a swarm of bees or a group of starlings. Like you see them like shifting in the sky and moving. But they're always a little bit different. I definitely think there's some rhymes, and I try, part of me, I'm like, look, baby, let's take out the 99 highs. Like, I'm ready. Come on. I asked Professor Schiller a couple of years ago. I was like, do you think we're going to take out 45? Do you think we're going to take out, these? But if you look back, he wrote a fun paper we can put in the show notes where he was looking at CAPE ratios on sectors in the Roaring 20s and Great Depression. And the hot tech stocks of the day were utilities and railroads. I mean, I guess utilities are kind of hot again. This was another fun stat, by the way. I'm full of trivia today. That you could pull up the Qs versus the utilities historically. They have like the same return. I feel like everyone just assumed the Qs crushes everything, but like you pull it back since inception and it's like they have the same return. Anyway, going back to the Great Depression and the Roaring 20s, those sectors were trading at capes of like 50 or 60, and then fast forward a couple of years, and guess what they were? 2. So there are rhymes on opportunities and booms and busts and kind of what's going on. I would never bet the farm on something like that. Saying, hey, this is 90s. I got to sell everything. I got to panic. Which is kind of the beauty of having a diversified global allocation plus trend as well. It's like you never have to be all in on something, which I feel like is almost like the biggest detriment to a portfolio. People, these binary approaches to markets. How many people do you know sold in 2009, couldn't take it anymore, and then never bought back in, right? Like that's heartbreaking to hear.
Yeah. And one of those interesting stats going back to the permanent portfolio before is I believe, and I don't know if it's been broken now, but like 2009 was like the biggest year for inflows into the permanent portfolio ever, which was not I'm a big fan of the permanent portfolio, but the time you wanted to be adding to it was not the beginning of 2009.
Yeah. If you look at sort of the global permanent and the permanent, Mark Faber, no relation, these type of portfolios going back, one of the benefits of all the various portfolios is they all do well. We often say in our old global asset allocation book, which we hope to update next year, said, doesn't really matter which one you pick over time, and the keyword being over time. The problem is, best to worst of all these portfolios, the yearly spread is like 30%. So it always looks like there's massive, crazy stuff going on in the world. Fast forward like 30 years and the spread is like 1 percentage point. So it's tiny. It's like very, very precise. But if you look at things like the 70s, you had to have some sort of real assets or value to even really survive that decade. But the permanent portfolio and things like that historically have been one of the most consistent across decades and periods of all the types of portfolios, because they do have that sort of real asset component that's often lacking in many modern portfolios.
How do you think about AI from the perspective of people like us who are building portfolios? Like, do you think it's going to offer a lot of value to us? Do you think we're going to be like typing in, give me, you are Seth Klarman, give me the best portfolio for the next 10 years or something? Like, do you see any value from it from the perspective of building portfolios?
Probably. So when you guys figure it out, let me know. People have been using various sorts of these techniques for quite a long time. But I'm open. I try to operate on an extremely long time horizon where we're trying to take advantage of people's just general stupidity, which I feel like is a lot easier than some of the short-term ideas, but I'm open to it. You guys find some secrets, passing them along.
Yeah, no, we're working on it as well. I mean, I agree with you. I think there's going to be a lot of value in it. We just got to figure out what it is. So speaking of long-term time horizons, I guess we can transition to value investing now. I want to get your thoughts on that in general, because we have seen some better performance from value recently, but you have a lot of people arguing, particularly like the simple value strategies, they're just chopping it to deciles based on various metrics, that those things just don't work anymore, that things have changed, everybody's doing it or whatever it is. Those types of strategies just aren't going to work going forward. And I just wanted to get your take, because you're, as you mentioned, you're one of the longest term thinkers I know. Like, how do you think about those types of strategies, those simple value strategies going forward?
There's oftentimes you hear something in markets, an idea, this is true in life too, and you can't forget a thing, right? Like you learn something and you can't forget it. And so Edward Macquarie, who is an academic historian who did a lot of work talking about how did stocks and bonds do in the 1800s, and he was pushing back a little bit against Siegel for saying, hey, look, stocks may not have done as good as you were saying, and bonds a little more competitive, but not really the point of what I was saying. He came up with an idea that I heard, and it's really hard to get out of my head, which he calls right-hand chart bias. And what that means is if you have an asset that's done well recently, or a strategy or approach, whatever it may be, it makes it look like it's done well forever. So if you pull up particularly a non-log chart of something, and it's done well for the past 5-10 years, U.S. stocks would be a good example. And then you pull up the chart and you're like, oh my God, well, this clearly always been the best choice. And his example is, he's like, let's just look at U.S. stocks versus U.S. bonds historically, but we'll chop it up in periods. And he's like, there have been plenty of periods where U.S. stocks and bonds had the same return. And not just periods of like a year or two, like many decades. And by the way, if you go back a couple of years ago, it was like U.S. stocks and bonds, long-term bonds had same return for 40 years. I think there was a period in the 1800s where it was like 60 something years. And then he'll look at a decade like the 70s where bonds just absolutely tanked. But because of these way they add up in the most recent performance, it looks like it's always been true. And so I think about that when I think about strategies, things like value, things like whatever it is, momentum trend, foreign stocks, gold, bonds, on and on. I tend to have a bit of a contrarian streak, and so I'm always looking towards things that have done really terribly. So value fits that bill. But value to me, when I think of like broad topics, is like, what's the alternative? Is the alternative that we should invest in companies that trade at 200 times revenue? It's not even 200 times earning this cycle, it's 200 times revenue. Like, it's just historically, and including this past period, it has been an absolutely atrocious idea. Like, one of the worst ideas you can do is buy very expensive stocks consistently. Like that's a recipe for disaster. And so I think, everything would break down if that was true. The whole system makes no sense if cash flow isn't the final arbiter. And so all these companies, these mega companies, at some point have to generate those cash flows, and it comes home to roost. It may not be this month, this year, but eventually. And what those companies are changes over time. Back in the day, energy was a third of the S&P, and now it's like 4%. So it waxes and wanes what people get hot and bothered about. Maybe if gold keeps creeping, maybe we'll be talking about, gold at 5,000-10,000. Like how we didn't all invest a third in gold in our portfolios. That was crazy, but that tends to be kind of what happens when everyone's, gotten rich off something.
And you wrote a great piece recently, I believe it was titled When to Sell, which gets at this whole time frame issue, which is, most people want to sell because I've underperformed in the past year and my friends are making tons of money buying unprofitable tech or something. And the real time frame to judge one of these types of strategies is like exceptionally long.
So thank you for complimenting that paper, because of the thousands of articles we've written, dozens of white papers and books and stuff. This has been the hardest one to complete, and I actually don't love it. However, I had to birth this thing. And the origin of this was my consistent frustration talking to investors of all stripes, not just, we love to look down on the little retail, but let's be clear, to me, professionals are as bad, if not worse, on this topic. And I basically wanted to publish this to then, very sophomorically send it to people after they sell our funds and be like, I want you to walk through this. It's like an index card. Like I want to send to people when they buy it and say, let's think about this ahead of time. Because I did a tweet this past week, we have one fund. I said, look, people, I talk to them all the time, and they're, say, Meb, here's my dream investment. I want a fund that's been amazing, like a top decile fund, clearly this is a great strategy. But the problem is, I don't want to buy it after an amazing period. I want to wait for a pullback, and then I want to buy it. And then I say, okay, great. I hear you, whatever. And in reality, it happens. And not only do they not buy it, they sell all of it. We're currently experiencing this with one of our funds. So despite doing this for well over a decade on the ETFs, we see people chase performance all the time on both good and bad. So we tried to walk through, said, hey, look, the number one kind of phrase people love talking about today is I'm an evidence-based investor, and I think people do spend a lot of time on the buy decision. Well, maybe on some people, they put a lot of effort into it, and then they buy something, and I often ask them, I say, well, what's your plan now? How do you plan on evaluating exiting this? And it's a blank stare 100% of the time, not even 99, 100% of the time. And really, they're like, well, I'm going to see how it goes. I'm going to buy this, and we'll see how it goes. I'm like, what does that even mean? How are you putting your clients and life's savings to work and then not even having a framework for how to even think about getting rid of this? And usually what it is it underperforms. It's some period, for a year or two, and they puke it out and move into whatever's been outperforming. And so this is really frustrating. And we tried to walk through this and say, we had Ken French on the podcast, and we said, Ken, how long, statistically speaking, do we need to know if an active manager is good? And he said 64 years. I said, okay, well, let's not go that long. But even Vanguard has some studies in the paper you mentioned. It's like, look, let's say you have the best funds over 10 years. How many years do they underperform? And it's a lot. It's like a coin flip on any given year. And if we know anything about coin flips, is you can underperform multiple years in a row. And so we said, look, what are the ways to think about selling that are reasonable? Let's write them down ahead of time. And so it's almost like a diet. And when you get to the point where the fund or strategy is sucking it up and you can't take it anymore, you're like, oh, why did I buy this? Why did those morons on excess returns talk about this strategy? It's so stupid. I can't believe it. But then you pull out this card and you're like, oh, wait, oh, okay. Find my Zen and be like, why am I even talking about evaluating this on a 1-year time horizon? Why am I even talking about evaluating this on a 5-year time horizon? It offers you no information whatsoever on a lot of these ideas. And so I think it's a fun piece. I think no one will read it. I think no one will change their behavior based on it. But at least it gives me a little bit of good feelings about having to say my piece.
I want to pivot maybe just for the last part here and talk about the ETF business a little bit more, some of the things you're up to over there. But the question I had for you is, and I think you know this, Meb, like Jack and I, when I was at Validia Capital, we had an ETF. And I remember going down to, I think it was UBS in like Jersey City or something, and sitting with their due diligence team, and we were trying to get up on the platforms and stuff. This was during the the days where you had to kind of go to the gatekeepers, and maybe you still do. You probably don't, given your size, but with some smaller ETF issuers, you still have to kind of do that roadshow, if you will. And I remember them asking us, like, what are your plans for launching other ETFs? And sort of Jack and I were always like, well, we don't really have any plans because we're putting all of our resources behind this one ETF, thinking like that was the right answer. But what Jack and I have talked about, like in retrospect, and it's easy to look at the time and say, what should we have done? How could we have answered it differently? Should we have done? But, we launched a small cap value ETF during a period where it was really, really tough in terms of performance. And eventually we had to shut that ETF down. And so in thinking about what we should have done, maybe we should have launched multiple ETFs if we had the capital and resources to do it, because maybe the value one didn't take off, but if we would have had a growth and momentum one, maybe the assets would have come in there. And then just overall, the Validia ETF ecosystem would have been on better footing, healthier ground or whatever. And maybe that ETF would have survived and we would have had other ETFs. But what I'm asking, or the reason I'm telling that story and what I want to sort of ask you is, you've done this for a long time in terms of running ETFs, launching ETFs, having a suite of successful ETFs. But is there something you would have done differently looking back? Like, what do you think, what maybe mistakes have you made, and what have you done well, I guess?
Well, there's a lot. So the people that are listening, the aspiring ETF managers out there, it's a little different today than it was 15, 20 years ago. Back then you had to get your own trust or partner with someone, and that was really expensive and time consuming. I think it cost us $500,000 and took over a year. Nowadays, anyone can launch them. So it's a little bit of a different setup. I think your perception is right. I think, diversifying across a suite of funds is a thoughtful way to go about it, because you never know what the regime is going to be. And also, you never know. I mean, the amount of times I see something launch and I'm like, that idea is brilliant, and then it doesn't raise any money. And then today, especially on the daily, I'm like, that is the dumbest idea I have ever heard of. It is predatory, it's expensive, it's tax inefficient, and it raises like $5 billion. So, I'm consistently, the other half of me is waiting on that bear market to clean out all the nonsense. So definitely, I think I would have loved to have launched all of our 20 funds from day one. The problem with that is, as you know, these are liabilities when they launch, and so we say the asset management business is a pretty garbage business at no scale. It's expensive. There's massive competition from firms that have infinite resources and 4 commas in their name. And then at kind of reasonable scale, it's an amazing lifestyle business. Think, Standard Financial Advisor. It's a great, great business. I think it's kind of future-proof on many levels. And then at scale, it's the best business in the world. Now, it's just so, like, how do you think about moving from A to B? But even with us, we try to only launch funds that don't exist. There's times when I'm like, oh my God, I'm going to set the world on fire with this fund. I'll give you a good example. We launched, at the time, was the US's first, maybe the world's, ETF without a management fee. And this was GAA. And this fund it had in its sight the entire $1 trillion plus mutual fund industry that does asset allocation and does nothing. So I'm like, I'm going to do an ETF. It'll be an ETF of ETF. So it's 0% on the wrapper, but I think it's like 40 bips or 30 bips or something. I don't even know. I'd have to look. And I said, this is going to take billions from these old dinosaurs that are tax inefficient. It's one of our smallest funds. I think it's like, the performance has been awesome. It's done really well and nobody cares. So I think diversifying, had that been our only fund, we wouldn't have made it. So I think that's a thoughtful approach. At the same time, the vast majority of the industry today is on the opposite side of the problem. And this is not the little guys. This is the big boys, listeners. We did a recent series called 20 Things You Probably Don't Know About Markets. And this is for pros too. And we consistently get people ask us, say, Meb, I'm worried you're going to shut this fund down. I'm like, you're asking me? I was like, the average public fund half closed over a decade. And guess who closes most of the funds? The big boys. There's a lot of these big shops that have closed 30 to 50% of the funds they've ever launched because they're in kind of the spaghetti chuck business, and the average public manager doesn't have any assets in their own fund. So, be wary, listeners, when one of the big dudes comes marketing some fund and, say, you doing this just because you want to hoover up some assets, or do you actually care about it? Do you think this is a product people should want and you're applying a fiduciary lens, or are you trying to do some dingback strategy just to hit your bonus? And I think a lot of the industry is dominated by the latter.
Talk about the things you're doing with the 351 exchanges and kind of what they are, and what type of investor would that make sense for?
Yeah. So 351, if you don't know what that is, and don't feel bad, 95% of the people I talk to have still never heard of this, despite my relentless preaching on this topic. When I heard it, this was another idea where I was like, oh, like hold the horses. Like this is amazing. It's an idea that's been in the tax code forever, but really found its perfect spouse with the ETF structure. And the concept, we try to tell people, if they're familiar with 1031 in real estate, it's a not too dissimilar idea, which is, we go back to the beginning of our conversation. There's a lot of people listening and be like, yeah, Meb, I hear you, but I'm a taxable investor and I got all Mag 7 or US stocks, and I can't move to small cap value or foreign or gold or whatever because taxman's going to kill me. So I'm stuck. And so 351 basically allows you to contribute stocks or ETFs to the launch or the seeding of a new ETF, get the ETF back, and it's a tax-deferred transaction, which is amazing. It's not a tax wash. Of course, that would be illegal, but it allows you to contribute property. So we're doing our next one in December. And so if you're an advisor out there and listening, you're saying, oh, this is perfect for me. Amazing. I got all these Mag 7 stocks, whatever, and I want to move into something else. The way it works is there's two main rules. So you can't just contribute 10 million NVIDIA. It has to be somewhat diversified. So the top position can't be above 25% and the top 50 can't be above 50%. So what does that mean? You either need to contribute at least 12 stocks or, giant asterisks, ETFs are pass through. And so if you have SPY, you could theoretically contribute 100% SPY because it looks through the underlying holdings. And so you get back whatever the ETF is doing. We've done 3 of these. They're kind of getting bigger and bigger as we go down the road. And then we'll probably have some more next year as well. And they've been on different strategies. We've had the world's least marketable strategy, which actually had the tax symbol back in December. Talk about an idea that is going to be a long hill to struggle with. And that's U.S. stock exposure with low to no dividends. But we also did a diversified strategy, a global strategy. And so I'm happy to get into any specifics. That's the broad ballpark.
Yeah, and are you finding that I could see from both the individual, but I'm curious is there like advisor adoption of this, where if you're an advisor, you have like 100 clients, maybe they're all in SMAs, but maybe not managed like in the same way. So it's not the same holdings. You could maybe get some of that. Well, I guess the advisor doesn't hold the ETF, the individual does, but still.
There's like three main use cases and then one idea. The first one is obviously concentrated stock. So if you're stuck in a bunch of Mag 7, or it doesn't even matter, like if you're a C-suite executive or you work at 3M or Microsoft, or you bought Berkshire nobody wants to sell Berkshire, that's a bad example. You bought Apple in the 80s, you bought whatever, and you hold a ton of it. This is a perfect off-ramp. Second is direct indexing. If you're doing long only, that's a great idea. Yeah, and this is all on the individual client level. Third is like a strategic rebalance. So if you're all in on US stocks and bonds and you want to move to, say, foreign stocks or diversified or something else, This is a good way to do it. Because if you were 60-40 in 2009, you're like 90-10 today. But the big one, and by the way, zero private equity people have heard of this, zero VCs. None of the wirehouses can do this. And so if you're an independent RIA, you have a moment in time that's not going to last forever. Let's call it maybe a year, maybe 2 years, where you can go to all your friends at UBS or their clients or people that won't even go to an advisor because they got 100 million, but you can't do anything with it. If I was an advisor, I would go to every public company within a 500-mile radius and say, let me give a presentation to your investor relations and employees. Because I know, NVIDIA, you have 5,000 employees that have a 20 million net worth or more, and you're stuck in the stock and you can't do anything with it. And no exchange fund wants your NVIDIA stock. So now we have an idea. Let me present to you. It is like the biggest lead gen possible if you're a financial advisor on the planet, because you also have this moment where no one else knows about it. And so we're seeing a lot of that. The early adopters, not surprisingly, financial family offices, very tax minded. They understand this. They're kind of, we get an email every day from some family office. I think 2026 will be the year that it hits mainstream. But given everything I've said in this conversation already, I obviously could be wrong and optimistic for no good reason, but I think it's a really, really fun idea. And by the way, if you want to put on your academic hat, you want to put on your thought about all the dangers of market cap weighting, why does this persist, right? Why do you have these bubbles where stock markets go to 40, 60, 80 PE? It's because you have taxable investors that can't sell those positions. And so they don't. They're stuck in these passive index. What if you had a way tax efficiently to defer those and to rotate into things that are not market cap weighted? All of a sudden, theoretically, you make the capital markets more robust, you make them less prone to bubbles. It's a solution to this consistent cycle of boom bust. I have to get my academic friends to work on this because above my pay grade, but we'll get Wes and crew maybe to write a paper on that idea.
So you've been on the podcast a couple of times, so our standard closing question can't be asked here. But what I do want to ask you is, what do you think has changed most in the markets over the last 20 years, both at the market level and also for investors themselves, like retail investors, individual investors?
I try not to be too dismissive of the youngins. I look at my 20-year-old friends that are YOLOing into weekly options and Dogecoin and prediction markets and everything else. And I'd be like, let's be honest, that was probably me in the 90s. Like I said, we called it CMGI and trading on E-Trade as opposed to Robinhood and everything else. So that's a story as old as time. I don't think that's changed. I think it's the best time ever to be an investor. We've said this over the years. The problem is it's a struggle of choice. You go to the grocery store and you're like, oh God, I just like 400 types of beer. Like can I like 200 types of cereal, which is a great problem to have, right? But at the same time, a lot of the industry, there's a lot of garbage out there. So when you read this new book, I'll send it to you guys, an early copy. It's called Time Billionaires. But the origin of this book, the idea was that I got really frustrated with the sort of COVID period where all of a sudden all these young people were getting led to the market. And I'm like, that's amazing, great. Highest percentage of equities that U.S. investors have held, most participation, awesome, awesome, awesome. But the entree was through the casino, right? Robinhood sending you confetti, trade as much as you can. Hey, buy these 5 times leveraged things. Hey, shiny object, buy some options in your retirement account, on and on and on. And I said, let's teach the lesson that's so simple, which is you put money to work and it's just magic. In 25 years, it's a 10 bagger. 50 years, it's a 100 bagger. You don't even do anything. It's the biggest most amazing magic trick in the world. You become very rich. And so the way we tried to do this was with that old 100-year chart, where it shows the crisis every year. But we took it back to 1600 and kind of said, well, look, if you just put money to work and ignored all the insanity, you don't have to go YOLO into these crazy meme stocks and other things. You actually can get pretty rich pretty quick. So we'll send you guys that over soon, and listeners, it should be out early next year, I hope. But
nice.
So the more things change, the more they don't, I guess, in many ways.
Yeah.
The other thing you didn't mention, Justin, is we can't ask Meb the new standard closing question because we blatantly stole it from him. Which is one thing to believe about investing that your peers would disagree.
That is true.
Oh, dude, we need to do like 5 episodes on that. You guys, I have so many. I have a running list of things I believe that no one else doesn't. And the new series is really fun. The 20 things that most people don't understand. There's some good ones in there.
Yeah, definitely a future episode for sure. So listen, Meb, thank you very much. We really appreciate it. Hey, if you go to the World Series with your son, enjoy it.
That's awesome. Go Dodgers.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.